think about everything you supposedly own in your digital life right now.
Right. Supposedly being the absolute key word there.
Exactly. Because, I mean, your photos, they are sitting on a massive server farm owned by some giant tech company.
A company that can restrict your access literally tomorrow.
Yeah. Or look at your social media followers. You could lose access to them in a heartbeat if, some opaque algorithm just decides you violated a brand new policy.
It happens all the time.
It does. Even the money in your banking app, it's really just it's just an IOU displayed on a screen.
Yeah, the bank is taking the actual capital and doing whatever it wants with it behind the scenes.
Exactly. We live in this era where we essentially just rent our digital existence, and we've all sort of just accepted it as normal.
Which is wild when you really step back and think about it.
It is. But what if you could fundamentally own a piece of the internet's underlying infrastructure? And I don't mean a share of a tech company, but like the actual digital real estate itself.
That right there, that is the core promise that pulls people into the world of cryptocurrency.
And it is an incredibly potent promise.
Oh, absolutely. The allure of true, unseizable digital ownership. That is the spark that ignited this entire industry.
Right.
But, the reality of a beginner actually trying to achieve that ownership, it's usually a completely different story.
Oh, it is a total nightmare for a beginner. You step into this space and the very first thing that hits you is just this wall of absolute chaotic noise.
Just a deafening wall of hype.
Yeah. You have influencers screaming on video about like the next massive hype coin that's going to make you a millionaire by Tuesday.
Which is mathematically impossible, by the way.
Right. And then you look at Twitter and it's just filled with people posting these insane charts, neon lines going in a million different directions, and they're speaking an entirely different language.
It's extremely intimidating.
It really is. It feels less like an investment landscape and more like a casino where everyone else knows the rules of a game you haven't even been taught yet.
And we have to be honest about this. That noise is entirely by design.
Wait, you think it's intentional?
Oh, 100%. The hype cycle thrives on confusion and urgency. I mean, if they can make you feel like you are missing out on the opportunities of a lifetime, you are far more likely to just throw capital blindly into poorly constructed projects.
Without asking any questions at all.
Exactly. No questions about utility or security or longevity. It's just a very predatory environment for the uninitiated.
Which is exactly why today we are taking a massive step back. We are welcoming you, our inherently curious listener, to a deep dive that is completely focused on cutting through every single decibel of that meme-filled noise.
I love this approach. We need this.
We really do. Today, we have a very specific, actionable mission. We are going to chart a clear, step-by-step path to a highly tangible goal.
No fluff.
No fluff, no day trading nonsense. We are mapping out the exact process for a beginner to reach a milestone of holding their first 1,000 ADA tokens on the Cardano network.
It's a phenomenal mission. And, to guide our analysis today, we're utilizing a brilliant piece of writing from a platform known as Normie Crypto.
Yes, the article is titled The 1,000 ADA Goal, Why Cardano Could Be a Generational Game Changer.
It's a great piece.
It really is. I spent hours poring over this site, and I just have to say, the ethos of Normie Crypto is exactly what this industry desperately needs right now.
Because they are explicitly targeting the normies.
Exactly. Which, for anyone who doesn't know, is just internet slang for everyday normal people who aren't, software developers or professional day traders.
Right. They're writing for the person who works a normal 9 to 5.
Yeah. The person who understands that the economy is shifting and who is looking for blockchain projects that actually do something in the real world rather than just like endlessly chasing internet hype.
And what really stands out about their approach is the accessibility.
Yeah.
I mean, blockchain architecture is, by its very nature, incredibly dense.
Oh, it's technically terrifying.
Yeah, it's intimidating. But the authors at Normie Crypto, they managed to strip away all that elitism.
And they have a fantastic sense of humor about the absurdity of this space, too.
They really do.
I mean, right alongside this deeply serious macroeconomic tech analysis, they have a merch store.
Oh, the merch is great.
They're selling these always HODL tank tops, complete with a little retro crypto rocket graphic and a never panic, always cool Space Cat heat change coffee mug.
I kind of want that mug, actually.
Right. It just proves they know exactly how to balance the heavy, complex nature of blockchain technology with the fun, slightly unhinged internet culture side of crypto.
And we should probably clarify some of that culture right out of the gate for you.
Yeah.
Because OGDL is a term you are going to see everywhere.
Oh, yeah. It is unavoidable.
It actually originated years ago from a frantic, drunken typo on a Bitcoin forum.
Wait, really? A drunken typo?
Yeah, a user misspelled hold during a massive price crash. He typed, "I am hodling" in all caps, and the community just aggressively adopted it.
That is hilarious.
It eventually became a backronym for Hold On for Dear Life. And it basically represents the philosophy of holding your digital assets through extreme market volatility rather than panic selling when the price drops.
It's basically the rallying cry of the modern crypto investor.
Right.
And that brings us directly to the core mission of our discussion today.
Right.
We are going to explain the literal step-by-step process of going from zero to holding those 1,000 ADO tokens.
But we aren't just giving you a dry checklist.
No, definitely not. We are going to thoroughly unpack the technological mechanisms and the economic logic behind why this specific milestone is considered by the authors to be a generational golden ticket.
The term golden ticket is really the focal point of their entire thesis here.
It's a bold claim.
It is. I mean, in traditional finance, finding a golden ticket usually means getting ground floor equity in a tech startup right before it goes public.
Which regular people never get access to.
Exactly. In the blockchain space, it's about finding a position that offers disproportionate long-term upside without requiring you to take on the irrational outsized risk of gambling on unknown, unproven networks.
Okay, let's unpack this. What exactly makes 1,000 ADA a golden ticket in this context? Because I have to be honest, when I first read that, my immediate thought was, well, why not Bitcoin?
A very fair question.
Right, because in the crypto world, investors are always hunting for that definitive, life-changing milestone. And for years, the ultimate golden ticket has been owning one entire Bitcoin.
It has been the holy grail for a decade.
Yeah, it's the holy grail. But the normie crypto guys argue that for the everyday person entering the market right now, today, targeting 1,080 is actually the smartest, most strategic move you can make.
They argue it transforms what they call your lunch money into a strategic generational stack.
Right. So why the pivot away from Bitcoin and toward Cardano for the everyday beginner?
To understand that, we really have to look at the psychology of unit bias and just the brutal reality of market math.
Okay, lay it out for us.
Look at Bitcoin today. If a curious beginner wants to secure that golden ticket of one whole Bitcoin, they're looking at a price tag at tens of thousands of dollars for a single coin.
Yeah, it's a massive barrier to entry.
For the vast majority of the global population, accumulating that kind of capital to put into a single, highly volatile digital asset is just mathematically impossible.
You'd literally need a bank heist to pull that off. It's just not realistic for a normal person who is paying rent and buying groceries every week.
Exactly. And when a goal feels that financially impossible, it creates instant psychological fatigue.
I can see that. You just give up before you start.
Right. The beginner looks at the chart, realizes they will only ever be able to own a tiny fraction, like 0.005 of a Bitcoin, and they simply don't take the first step.
Because it doesn't feel like ownership.
Exactly. It feels like buying a few grains of sand on a massive beach. It's unfulfilling. And this is where the 1,000 ADA strategy becomes so incredibly powerful.
Okay, how so?
What's fascinating here is how this approachable, realistic goal relies on absolute, hard-coded scarcity.
Right. Let's dig into that math. Because the scarcity principle is where this whole concept really clicks.
It is the foundation of the whole strategy.
The Cardano network, much like Bitcoin, is built on a fixed, mathematically capped supply. There will only ever be exactly 45 billion ADA tokens in existence, period.
It is not infinite.
Right. The Federal Reserve cannot just decide to print another 10 billion ADA to bail out a failing bank. The limit is hard-coded into the immutable rules of the network.
And hard-coded isn't just a tech buzzword here. It means that the total supply is written into the foundational cryptography of the software.
The software that every single participant runs.
Right. Every node in the global network agrees to run it. To change that 45 billion cap, you would have to somehow convince millions of decentralized participants worldwide to voluntarily accept a software update that instantly devalues their own holdings.
Which is never going to happen.
It is practically impossible.
So, 45 billion. That is the hard ceiling. Now, I'll admit, when I first read that number, 45 billion sounded absolutely massive to me.
It does sound like a lot.
It doesn't sound scarce at all. I mean, how can something be a golden ticket if there are 45 billion of them floating around?
That is the exact question every beginner should ask. And it's where we have to separate the total supply from the circulating liquid supply.
Okay, break that down for us.
Yes, the absolute ceiling is 45 billion.
Yeah.
But the article highlights a critical mechanic of the Cardano network, which is staking.
Which we will get into heavily later.
We will dive deep into how staking works, technically a bit later, yeah. But from an economic perspective right now, you just need to know that millions of users are actively locking up or staking their ADA to help secure the network.
And when those tokens are staked, they aren't just sitting on an exchange like Coinbase waiting for someone to buy them.
Precisely. They are effectively removed from the liquid, actively tradable supply.
Oh, wow. So the supply shock is built in.
Exactly. A massive percentage of all the ADA in existence is tightly held by people who have zero intention of selling it anytime soon because it is actively working for them.
Right.
So the actual amount of ADA readily available for a new buyer to purchase at any given moment is significantly lower than that 45 billion number suggests.
Which means the scarcity is very real.
A lot.
And that leads directly to the price vision the article explores.
Which is always the fun part.
Always. They point out that while nobody has a crystal ball, and we all know the crypto market is notoriously unpredictable, many macro analysts look at the size of the global financial market. They look at Cardano's fixed supply, and they project that ADA could hit the $5 to $10 range in a full-blown bull market.
And we should probably define what a bull market actually means in this context, because it's a term thrown around constantly on social media.
Yeah, please do, because it's not just a good week on the charts.
Not at all. A bull market isn't just a few days of prices going up. In the cryptocurrency space, a bull market refers to a prolonged period, usually lasting many months or even a year, where massive amounts of global liquidity floods into the asset class.
So we are talking fresh capital from institutional investors and retail buyers?
Exactly. It's a period of euphoric buying. It's often triggered by broader economic conditions like lowered interest rates or major technological adoptions. And during this time, demand vastly outstrips the available supply, which drives prices exponentially higher.
And if that macroeconomic flood of liquidity happens and ADA actually hits that conservative $5 to $10 projection, the math for the beginner completely changes.
In James's average.
Your stack of 1,000 ADA suddenly transforms from a weekend hobby, something you slowly built up by sacrificing your daily coffee budget, into a $5,000 to $10,000 asset.
It shifts the entire psychological framing of the investment. You're no longer just, throwing a few dollars at a speculative internet coin.
Right.
You are systematically accumulating a measurable, defined percentage of a finite digital resource right before institutional adoption scales up.
But I want to push back on the psychology of the number itself for a second.
Okay, go for it.
Let's really look at this. Why exactly 1,000? Why not tell beginners to aim for 500 ADA? Or 5,000 ADA? I mean, if the tech is so great, shouldn't the goal be as high as possible?
It's a delicate balancing act between ambition and psychological friction.
Okay.
If you set the goal at 500, it might not feel substantial enough to motivate the discipline required to hold it through a 2-year market downturn.
You might just sell it because it doesn't feel important.
Exactly. But if you set it at 5,000, you run right back into the unit bias problem we discussed with Bitcoin. It becomes too expensive too quickly, and the beginner just gives up.
Ah, I see. The absolute genius of the 1,000 ADA strategy from Normie Crypto is that it feels like a heavy, substantial milestone, but it is deeply psychologically accessible.
You can break it down into chunks.
Right. You can buy 10 ADA this week. You can buy 50 ADA next month. It gives the listener a concrete, realistic finish line that doesn't demand they liquidate their entire life savings or take out a second mortgage.
It is strategically sized.
And that strategic sizing is exactly what makes it the normie's golden ticket. It is the perfect intersection of affordability today and structural scarcity tomorrow.
It respects the beginner's current financial reality while aggressively positioning them for the future.
So if you, the listener, are tracking with this financial logic, the very natural next question is the execution.
How do we actually do that?
Exactly. How do you actually start acquiring this asset without getting scammed or losing your money in the chaos? And beneath that, why is the underlying code of Cardano actually worth putting your hard-earned lunch money into in the first place?
This brings us to step 1 of the strategy, which is the acquisition phase. And it is vital to understand that buying your first cryptocurrency isn't just about throwing fiat currency at a ticker symbol on a screen.
Right, and by fiat currency, we mean your everyday government-issued dollars or euros.
Exactly. Step 1 is where the rubber meets the road. For the absolute beginner, the literal first step is opening an account on a major regulated, centralized exchange.
We're talking about massive platforms like Coinbase, Kraken, or Binance.
Right. These are the on-ramps. They take your fiat dollars from your traditional bank account and allow you to trade them for digital assets.
But the source makes a very sharp, almost aggressive distinction here about what you should be buying once you actually get onto that exchange.
They have to be aggressive about it because the moment you log into Coinbase or Binance, you are presented with a dizzying menu of thousands of different cryptocurrencies.
It's totally overwhelming.
It is. And many of those options are explicitly designed to prey on your desire for quick wealth. The normie crypto authors deeply contrast the foundational strength of ADA with what they call moonbags and memes.
I laughed out loud when I read this section. There is literally another article listed on their site with the headline, Fartcoin or Future, Why Memes Aren't Global Reserve Assets.
It's a great title.
It sounds utterly ridiculous, but it perfectly encapsulates the utter nonsense you have to navigate in crypto.
It really does.
You have highly engineered technological networks sitting right next to tokens created as a literal joke by a teenager an hour ago, and the exchange displays them exactly the same way.
And it's not just a joke. It's a systemic problem in the broader industry. The crypto market heavily incentivizes a philosophy of move fast and break things.
Silicon Valley style.
Exactly. Venture capitalists and anonymous developers will throw together a blockchain or a token in a matter of weeks. They copy and paste existing code, slap a dog meme on it, and rush it to the exchange to capture retail liquidity.
They just want your money before you have time to look under the hood.
Right. And what happens when you build a global financial network in 3 weeks?
It shatters.
It shatters completely. You see it constantly in the news. They suffer from massive hacks. A smart contract, which is just a piece of self-executing code on the blockchain, will have a tiny logical flaw that the developers didn't bother to test.
And a hacker finds it?
A hacker exploits it to drain hundreds of millions of dollars in seconds. Or the network simply gets congested and shuts down completely, meaning you literally can't access your funds for days.
Which is terrifying, but Cardano takes the exact polar opposite approach.
They do.
Here's where it gets really interesting. The source points out that Cardano's entire developmental ethos is measure twice, cut once. They do not rush.
Not at all.
They utilize what's known as peer-reviewed code. They use mathematical proofs and formal verification to ensure the network is fundamentally built to last.
It's a very academic approach.
Right. Let me try to visualize this for you, the listener. Let's say you are buying the raw materials to build a house for your family. You go to the lumberyard, and you have a choice.
Okay, I like this.
You can buy the incredibly cheap, flashy materials that were thrown together overnight. Those are the meme coins. And they look totally fine sitting there on the shelf.
Right, but those materials are inherently brittle.
Exactly. The second a storm hits, your house just completely collapses. And in the crypto world, that storm is a vicious, sophisticated hacker or a massive spike in network traffic.
That's a really good starting point. But let's take that analogy deeper into the actual mechanism of peer review.
Let's do it.
When Cardano developers want to implement a new feature, they don't just write the code and push it live to the network.
Like the meme coin guys do.
Right. Instead, they write an academic paper detailing the cryptography and the game theory behind their proposed update. They then submit that paper to global cryptography conferences.
Wow. So they present it to the experts first.
Yes. It is brutally scrutinized, attacked, and verified by independent academics, mathematicians, and software engineers who have absolutely no financial stake in the project.
They are actively trying to find the flaws before a single line of actual code is implemented.
Exactly. It's the exact same methodology used in aerospace engineering or writing nuclear facility software.
That is a serious comparison.
It is, because you use formal verification, which is a way of mathematically proving that the code will behave exactly as intended under all possible conditions. You do this because the cost of failure is catastrophic.
Cardano treats its blockchain with that level of severity.
They treat it like mission-critical infrastructure.
It is the foundation that does not crack under pressure.
Yeah.
But honestly, I can hear the crypto veterans groaning right now.
Oh, I know what they're going to say.
Right. They always complain that Cardano moves too slowly, that they take years to release updates while other chains are launching a new shiny feature every single week.
And from the perspective of a hyperactive day trader who's just looking for instant gratification, that criticism makes total sense.
Sure.
But we have to extrapolate on why this slow and steady, mathematically verified approach is so absolutely crucial for step one of the beginner's journey.
Right, for the normie.
Entering the crypto market is inherently terrifying for a normal person. The volatility of the fiat price, just watching your portfolio jump up or down 15% in a single day is extreme.
It will make your stomach drop.
Exactly. If your first step into this world involves buying an asset that could literally cease to exist tomorrow because of a sloppy coding error, that anxiety is magnified exponentially.
You'd be constantly checking your phone, sweating over whether the network even still exists or if it got hacked overnight.
But the beginner who buys their first ADA on Binance or Coinbase can actually sleep at night.
Because they know the foundation is solid?
Yes, they have the absolute, verifiable assurance that the underlying architecture of the investment they just made is mathematically sound. It isn't going to spontaneously break.
The measure twice, cut once philosophy.
It removes a massive layer of technical and structural risk from the equation. It allows a beginner to focus purely on the discipline of reaching that 1,000 ADA accumulation goal, rather than worrying if the bridge they are standing on is going to collapse.
That is such a vital point. The peer-reviewed nature of the tech acts as a psychological safety net for the normie investor.
It really does.
You buy it on the exchange, and you know the asset itself is solid. But, as the Normie Crypto article makes aggressively clear, buying your ADA on Coinbase or Binance is only the beginning.
It is barely the starting line.
In fact, if you just stop there and leave it on the exchange, you are entirely missing the point of the blockchain revolution.
Leaving your newly acquired digital assets on a centralized exchange completely defeats the core ethos of cryptocurrency.
It's just Web 2 all over again.
Exactly. It is the antithesis of ownership. And it leads us directly to what is unquestionably the most critical, non-negotiable step in the entire beginner's journey.
Self-custody.
Self-custody.
The golden rule, the absolute law of the land. The article spells it out in bold letters. Not your keys, not your ADA.
You hear that phrase everywhere, for good reason.
Step 2 of this journey is moving those tokens off the exchange, withdrawing them from the control of Coinbase or Binance, and transferring them into a self-custody wallet.
And they specifically recommend software wallets designed for Cardano, like Lace or Yoroi.
This transition is monumental. The source literally states that making this withdrawal is when the real game starts.
Because it changes your relationship to the asset.
Okay, but I have to admit, when I first learned about this step years ago, I was incredibly confused and resistant.
A lot of people are.
I want to play devil's advocate for the listener who is hearing this for the first time. If I just bought my ADA on Coinbase, an app run by a publicly traded, multi-billion-dollar American company with huge compliance departments, why on earth would I go through the hassle of taking it off?
It does seem counterintuitive at first.
Right. I have to download a new piece of software like Yoroi. I have to write down this weird list of 15 random words called a recovery phrase. I have to physically hide that piece of paper in my house, and I have to pay a transaction fee to move it. Isn't it just infinitely easier and safer to let the massive tech company hold it for me?
It is absolutely easier. There's no denying that. But it is not safer, and is certainly not ownership.
Okay, explain why.
To understand why, we have to explain the mechanism of what a centralized exchange actually is. When you buy ADA on an exchange, the exchange doesn't create a specific individual digital vault just for you.
They don't?
No. They hold massive pools of ADA in their own centralized corporate wallets. What you see on your screen when you log in is basically an IOU.
Just numbers on a database.
Yes, the exchange is simply keeping an internal ledger that says, we owe this user 1,000 ADA.
It's exactly like a traditional bank. The dollars in your checking app aren't sitting in a cubby with your name on it in a vault. The bank just owes you that money.
Exactly.
Let me try another analogy. Leaving your ADA on an exchange is basically like going to a convenience store, buying a winning lottery ticket, but then deciding to let the store clerk hold on to it for you just because you don't want the hassle of carrying it in your pocket.
That perfectly illustrates the vulnerability. You theoretically possess the value of the asset, but you do not possess the actual physical control over it.
Right.
If that convenience store clerk decides to lock the doors and walk out the back with your ticket, you have nothing. And in the crypto world, we have seen this exact scenario play out on a massive scale.
Oh, we definitely have.
When a multi-billion-dollar exchange like FTX collapsed recently due to massive fraud, millions of users who thought they owned crypto realized they only owned IOUs.
It was devastating.
When the exchange went bankrupt, those IOUs became utterly worthless. The users lost everything.
Because not your keys, not your ADA. But let's demystify that phrase, because keys makes it sound like We were talking about a physical brass padlock. What is a key in this context?
When we talk about keys, we are talking about high-level cryptography. A self-custody wallet like Lace or Yoroi doesn't actually hold your ADA tokens like a digital piggy bank on your phone.
Wait, they don't?
No, the tokens always live on the public Cardano blockchain. What the wallet software holds are your cryptographic keys.
Okay, explain the blockchain part.
Think of the blockchain as a massive wall of millions of transparent lockboxes. Everyone in the world can see the ADA inside your lockbox, but nobody can touch it.
Okay, transparent lockboxes. I can picture that.
Right. And your wallet software generates a unique, mathematically unforgeable private key. It is an immensely complex string of data that acts as the only physical key in the universe capable of opening your specific lockbox to move the ADA inside.
So whoever holds the key controls the ADA.
Exactly. When your ADA is on an exchange, the exchange holds the private key. When you download your ROI, create a new wallet, and withdraw your ADA from the exchange to that wallet, you're moving the funds to a completely new lockbox where you and only you possess the private key.
Which means no CEO, no government entity, and no hacker targeting a centralized database can freeze your account, block your transfer, or seize your assets.
Because they physically can't.
If you hold the keys, you hold absolute sovereignty over the asset.
Precisely. And this is where the Normie Crypto article pivots to something really fascinating. There is a much deeper layer to self-custody than just protecting yourself from a bankrupt exchange.
Okay, what is it?
If we connect this to the bigger picture, holding your own keys is your direct bridge to understanding enterprise-grade infrastructure.
Yes. The article dives into the real-world utility that gives these self-custody tokens their fundamental value. Because a token is just digital math unless it actually does something out in the world.
It needs a use case.
And they highlight that Cardano isn't just a speculative casino, it's being used to build massive global systems. They specifically mention the network being used to track educational IDs in Africa and to secure complex global supply chains.
And we really have to unpack the mechanism of why a blockchain is necessary for those things. Let's look at the African educational ID example.
Sure.
In many developing nations, academic records and identities are stored on fragile, centralized government servers, or worse, just physical paper in a filing cabinet.
Which is incredibly risky.
These are easily destroyed by conflict, lost to corruption, or simply mismanaged. A student could spend years earning a degree, and if that server goes down, they have no way to prove their credentials to an employer.
They literally lose their identity.
By utilizing Cardano's architecture, those academic credentials can be cryptographically hashed and anchored directly to the blockchain.
Using those transparent lockboxes we talked about.
Exactly. Because the blockchain is decentralized and distributed across thousands of computers globally, those records become immutable. They cannot be altered by a corrupt official, and they cannot be destroyed by a localized server failure. The student holds the cryptographic keys to their own identity.
And the source mentions supply chains as well, bringing in massive Fortune 500 giants like IBM and Dish Network. Now, why does a behemoth like IBM care about the Cardano blockchain? Why don't they just use their own private servers? They have plenty of money.
Because a global supply chain, say, tracking a microchip from a factory in Taiwan to a warehouse in Germany to an assembly line in the United States, involves dozens of different competing companies, customs agencies, and logistics providers.
It's a massive web of untrusted parties.
Right. If IBM uses a private server, all those other companies have to blindly trust that IBM isn't altering the data to cover up a mistake or delay.
And nobody wants to trust a single central authority when millions of dollars are on the line.
Exactly. They need a neutral, mathematically verifiable, decentralized ledger. They need absolute, unbreakable security. And Cardano provides this through a unique architectural design called the EUTXO model.
Which stands for Extended Unspent Transaction Output.
Yes. And without getting lost in the deep technical weeds here, what you really need to know is that this specific model allows for determinism.
Determinism, meaning you can determine the exact outcome of a transaction before it even happens.
Exactly. On other popular blockchains, when you send a complex transaction or execute a smart contract, you don't actually know for sure how much the transaction fee will be or if the transaction will even succeed until after you submit it to the network.
That sounds chaotic.
It's like swiping your credit card at a gas station and not knowing if you'll be charged $2 or $200 until the receipt prints.
Which is completely unacceptable for a Fortune 500 company trying to process thousands of logistical transactions a minute. They need absolute predictability.
Yes, they do. Cardano's architecture allows you to calculate the exact fee and verify that the transaction will succeed locally on your own machine before you ever broadcast it to the network.
Oh, wow.
It is predictable, secure, and infinitely scalable. So when these megacorporations are exploring blockchain solutions, they are not looking at retail hype. They do not care about internet
They
memes.
want the boring, reliable tech.
They are looking for the decentralized, deterministic security that cannot be compromised by a single point of failure.
And here is the major aha moment for you, the listener. By going through step 2, by moving your 1000 ADA off the exchange, generating your own private keys, and holding them in a Yoroi or Lace wallet, you are actively participating in the exact same decentralized security model that attracts these massive legacy tech giants.
You aren't just holding a digital coin. You are holding a piece of enterprise-grade infrastructure.
It's profound.
You are holding the raw material that powers those immutable African IDs and secures those global supply chains. And you can only truly claim ownership of that infrastructure when you actually control the keys.
Okay, so let's recap where our beginner is at right now.
Right.
They've understood the scarcity. They've navigated the exchange to buy the mathematically sound, peer-reviewed ADA. They've generated their private keys, taken self-custody, and secured their asset in a Lace or Yoroi wallet.
They have achieved absolute true ownership.
But now what? The tokens aren't supposed to just sit in that digital lockbox gathering dust, right?
Not at all. And that leads us directly to step 3 of the normie crypto strategy, which is where your asset fundamentally transitions from being a passive store of value into an active yield-generating engine.
Yes. Step 3. Staking and the pursuit of passive income.
Everyone's favorite topic.
Right. The article explains that once you own your ADA in your own wallet, you can stake it. By doing this, your 1,000 tokens are put to work, earning rewards and steadily growing your total balance while you sleep.
It's compounding growth.
But I really want to dig into the how here, because passive income sounds like a late-night infomercial scam. Where is this free money actually coming from?
To understand the economics of staking, we really have to understand how a decentralized network stays secure without a central boss running the show.
Okay.
We mentioned earlier that there are millions of lockboxes on the blockchain. Well, someone has to act as the accountant, verifying every single transaction, ensuring nobody is double spending their ADA and locking those transactions into the permanent ledger.
Right, because there's no bank doing it.
Exactly. In a centralized system, a bank's servers do this. In a decentralized blockchain, independent computers around the world, which are called nodes, do this work.
And running a node requires real hardware, electricity, and technical expertise. People don't just do that for free.
Right. They need an economic incentive. So the blockchain protocol is mathematically programmed to pay these node operators newly minted ADA, drawing from that fixed 45 billion total supply as a reward for honestly verifying transactions.
This is what's known as the consensus mechanism.
Yes, but here is where Cardano's specific consensus mechanism, which is called proof of stake, gets incredibly elegant.
And this is powered by the Ouroboros protocol, which the source absolutely raves about.
Yes, Ouroboros is the specific engine that drives this. In Ouroboros, the network doesn't just randomly pick a node to verify a transaction. It randomly selects a node based on how much ADA is staked or delegated to it.
So size matters.
The more ADA a node has backing it, the more often it is selected to process blocks of transactions, and therefore the more rewards it earns.
Okay, so how does our beginner with just 1,000 ADA fit into this? They obviously aren't going to buy a server and run a complex node in their basement.
They absolutely don't have to.
Yeah.
This is the beauty of delegation. Right inside your Yoroi or Lace wallet, with literally the click of a button, you can mathematically delegate the voting weight of your 1,000 ADA to a public node run by a professional.
Just delegating the weight.
You are essentially saying to the network, I trust this node operator, to be honest, and I am putting the mathematical weight of my 1,000 ADA behind them.
Well, and this is a crucial point for beginners who have been burned by crypto scams before. When you delegate your ADA to a node, you are not sending them your tokens. Right?
Absolutely not. This is a vital distinction from centralized lending platforms that went bankrupt recently, like Celsius or BlockFi.
Right.
When you stake your ADA, your tokens never leave your wallet. You retain the private keys. The tokens are never locked up. You can send them back to an exchange and sell them 5 minutes after you stake them.
Oh, that's huge. Total liquidity.
You are only delegating the cryptographic right to participate in consensus. You are not handing over the asset.
And because you are providing the node with the mathematical weight it needs to get selected and earn rewards, the protocol automatically splits those rewards with you.
Exactly. The network pays the node operator a small fee for their hardware costs, and it drops your percentage of the newly minted ADA directly into your wallet automatically every 5 days.
Every 5 days.
Every 5 days. This is the mechanism of passive income. You're being paid a yield not from some risky corporate trading desk, but directly from the immutable code of the network itself as a reward for helping to secure it.
That is brilliant. But the Normie crypto authors highlight another monumental aspect of the Ouroboros protocol, and it has to do with how it achieves this consensus compared to the older networks.
This is a massive selling point for institutions.
They specifically point out that Ouroboros is incredibly energy efficient, giving Cardano what they call the ESG advantage.
We really have to contrast proof of stake with Bitcoin's model here, which is called proof of work.
Okay, how does proof of work function?
In proof of work, the network secures itself by forcing the nodes, which are called miners, to solve impossibly complex mathematical puzzles. The first miner to solve the puzzle gets to verify the block and earn the Bitcoin reward.
Which means you have these massive warehouses in Texas and Iceland filled with thousands of specialized computers running at maximum capacity 24/7.
Just burning astronomical amounts of electricity just to guess a random number faster than the warehouse next door.
It uses the energy output of a small European country.
Right. And while proof of work is undeniably secure, its extreme energy consumption is becoming a massive liability in the modern financial world. And this is where the acronym ESG comes in.
ESG stands for environmental, social, and governance.
Yes. Over the last decade, massive institutional investment firms, we're talking the BlackRocks and Vanguards of the world, who control trillions of dollars, have implemented strict ESG mandates.
Meaning they are legally and ethically bound by their own corporate bylaws to only invest their clients' money in sustainable green technologies.
Exactly. Green energy is no longer just a nice-to-have public relations talking point for these guys. It is a strict regulatory requirement for massive capital allocators.
They can't ignore it.
Many of these funds physically cannot allocate billions of dollars into a network that burns the electricity of a small nation just to process transactions. It violates their ESG compliance.
But Ouroboros doesn't require massive computer warehouses burning coal.
Because it uses math and economic incentives, the staked ADA, to secure the network instead of brute force electrical computation, the entire global Cardano network can run on a fraction of the energy used by a single small town.
Wow.
You could literally run a Cardano node on a low-power Raspberry Pi computer. It is astonishingly green.
So what does this all mean? Let's synthesize this for a second, because the elegance of the system is just breathtaking.
It really is.
By taking step 3 and clicking stake inside your personal Lace wallet, you are putting your 1088 to work, earning a steady stream of passive income. But simultaneously, you are actively participating in an eco-friendly consensus mechanism that is specifically architected to be perfectly compliant with the strict ESG mandates of the trillions of dollars in institutional capital looking for a green entry point into blockchain technology.
It is a profound, almost philosophical alignment of incentives. If you really want to understand the magnitude of this, compare staking your ADA to traditional finance.
Let's do that.
In a legacy system, you put your fiat currency in a bank savings account. What does the bank actually do? They take your money, they lend it out to hedge funds or leverage it in risky derivatives markets. They reap enormous asymmetric profits, and they hand you back a fraction of a single percent in interest.
The bank takes all the profit, and when they blow themselves up taking too much risk, the taxpayer bails them out.
Exactly.
Your goals as a saver and the bank's goals as an institution are completely detached. You are just cheap liquidity for their casino.
But staking ADA completely flips that dynamic on its head. It democratizes the base layer of finance. It directly aligns the beginner's desire for passive income with the health and security of the entire global network.
Because everyone wins together.
Right. You aren't handing your money to a risk-taking middleman. You are being paid directly by the protocol for providing the foundational security that makes the network valuable to those Fortune 500 companies tracking their supply chains.
It really is a masterclass in how a modern, equitable financial system should operate. It rewards the individual directly for participating in the health of the collective.
It's beautiful design.
Okay, so let's look at our beginner now. We have the careful acquisition on the exchange, We have the withdrawal to self-custody using private keys, and we have the staking for passive, eco-friendly yield.
They've done everything right.
The beginner is sitting there with 1,000 ADA, safely secured in their Yoroi wallet, growing slowly every 5 days, powered by peer-reviewed tech. Honestly, it sounds like a complete victory.
It does.
It sounds like the end of the journey. But the Normie Crypto source reveals that there is one final ultimate step to unlocking the full potential of this golden ticket.
And this final step is arguably the most revolutionary of all because it has absolutely nothing to do with fiat price predictions, bull markets, or passive income yields.
Oh, really?
It has everything to do with power, agency, and voice.
Step 4 is what the article vividly calls the end game. Governance in the Voltaire era.
The Voltaire era.
The source states that the Cardano network is currently evolving into its final foundational phase, known as the Voltaire era. And the defining characteristic of this era is that it gives ADA token holders an actual mathematically enforceable say in how the entire network is run and funded.
This is the culmination of the entire Norney strategy. It is the moment where holding 1,000 ADA evolves from being a purely financial investment into becoming an instrument of active governance.
It becomes political.
It becomes about having a literal vote in what the authors beautifully described as a digital nation.
A digital nation. Let's revisit that specific prime real estate concept from the text earlier, because it really crystallizes the idea.
It's a great analogy.
The article says that having a solid self-custodied base of ADA is like owning prime real estate in a city that's still being built.
Right.
But the transition into the Voltaire era changes what that real estate actually means. When you have your 1,000 ADA staked in the Voltaire era, you aren't just passively renting an apartment in that digital city, just hoping the property value goes up.
You aren't a tenant.
You own the land.
Yeah.
And because you own the land, you get to vote on where the city built its roads, what the zoning laws are, and most importantly, how the city's massive multi-million-dollar treasury is spent to fund new developers and projects.
This raises an important question for you, the listener, to deeply consider. I want you to think about the traditional corporate structures we interact with every single day in the current iteration of the internet, what we call Web 2.
Okay, like who?
Think about massive platforms like Facebook, Twitter, Google, or even your traditional multinational bank.
Right. Web 2 is the internet of reading and writing, but entirely centralized control. As a user, I have absolutely zero say in how those platforms operate.
No.
The executives and the board of directors make decisions in a closed boardroom in Silicon Valley. If they want to change the algorithm to hide certain content, they just do it. If they want to sell my data, they do it. I just have to live with the consequences. I am not an owner. I am just a consumer of their product.
In many ways, your attention and your data are the product being sold. The asymmetry of power is absolute. The shareholders extract all the value, and the users have no voice.
It's very extractive.
But in the Web3 space, which represents the internet of reading, writing, and owning, and specifically in the Voltaire era of Cardano, that deeply entrenched dynamic is completely shattered.
How does the mechanism of that voting actually work for the beginner with their 1,000 ADA?
It is entirely integrated into the blockchain itself. It's called on-chain governance. The Cardano network has a massive treasury funded by a tiny fraction of every transaction fee.
So it self-funds.
Yes. Developers submit proposals to the network, say, we want funding to build a new decentralized exchange, or we want to upgrade the cryptographic signature process. Through your wallet, using the exact same private keys that secure your funds, you can review those proposals and cast a cryptographic vote.
And how is the vote weighted?
1 ADA equals 1 vote.
Meaning those 1,000 stake tokens give a normie, an everyday beginner who started their journey just by nervously buying a little bit of crypto on Coinbase with their lunch money, an actual mathematically secured seat at the table.
Exactly. Your vote is recorded on the exact same immutable ledger, and it's counted by the exact same consensus protocol as the votes cast by the original core software developers, the massive institutional players, and the venture capital funds.
The playing field is totally level.
The code does not care who you are. It only respects the cryptographic weight of your ownership. It is the purest form of liquid democracy currently operating at a global scale.
The empowerment aspect of this is just staggering to me. It is a complete paradigm shift in how we think about our relationship with the technology we use.
It changes everything.
You are transitioning from a passive, monetized consumer into a voting citizen of a borderless global platform.
It truly is. And if you take a moment to synthesize and briefly recap this entire normie strategy from start to finish, you can really see how elegant, protective, and progressive it is for the everyday person.
Let's walk through the arc of it.
You start small. You don't leverage your house or take on massive crushing debt to buy a whole Bitcoin. You take manageable amounts of fiat currency and you acquire a mathematically sound, peer-reviewed asset on a centralized exchange. That's step one.
Right.
Then you learn the fundamental mechanics of cryptography. You generate your own private keys and move the asset into a self-custody wallet like Lace or Yoroi, shielding yourself from corporate bankruptcy. That's step two.
You take true ownership.
Then you activate the asset. You systematically stack those tokens over time until you hit that psychologically achievable 1,000 ADA mark. You delegate those tokens to a node to secure the network, tapping into an eco-friendly consensus mechanism that earns you a continuous passive yield. That's step three.
And then the end game.
And finally, in step four, you evolve into a participant in governance, preparing to exercise your voting rights in the Voltaire era to shape the future of the very infrastructure you own.
It takes you from being an absolute beginner staring blankly at a chaotic, noise-filled trading screen to becoming a self-custodial, passive income-earning, voting citizen of an eco-friendly digital nation.
It's quite the journey.
A nation that, as the source pointed out, isn't just trading internet pictures, but is simultaneously tracking vital educational IDs in developing nations and providing the deterministic security required by Fortune 500 supply chains.
Real-world utility.
The fact that a seemingly simple, approachable goal acquiring 1,000 ADA can systematically unlock that level of sophisticated, modern digital ownership is just incredible to me.
It is a profound financial and technological journey. It fundamentally redefines what it means to participate in the digital economy of the 21st century.
It really does.
And as we conclude our analysis of this roadmap today, I want to leave you, the listener, with a final, slightly provocative thought to mull over.
Lay it on us.
We spent a lot of time today talking about Cardano's hard-coded fixed supply of 45 billion tokens acting as the scarce land of this digital city.
Right.
And we talked about massive institutions like IBM needing the deterministic security of that network, effectively acting as developers starting to build their technological skyscrapers on that land.
Right. Massive demand meeting a strictly fixed supply.
So consider the mechanics of what happens next. What happens to the extreme scarcity and consequently the underlying value of your 1,000 ADA prime real estate once the Voltaire era fully matures?
Okay, where are you going with this?
What happens to the liquidity of the global market when every single everyday token holder realizes the true power of their self-custodied asset?
Yeah.
What happens when millions of people suddenly refuse to sell their stack? Not because they are waiting for a temporarily higher fiat price in dollars or euros, but because they realize they value their immutable voting power and their permanent voice in that digital nation far more than they value the rapidly inflating government currency they could get for selling it.
Wow. If nobody is willing to sell their voting power, the available supply drops to near zero while the institutional demand continues to climb.
Exactly.
That is the kind of macroeconomic question that really makes you rethink the entire landscape of what it means to hold a digital asset. It's not just a trade, it's a stake in the ground.
A literal stake in the future of the internet.
Thank you so much for joining us, for pushing past the noise, and for exploring these complex, fascinating concepts with us today. Keep asking those big questions, keep exploring the mechanics of this incredible space, and maybe, just maybe, remember to never panic, always HODL.